the 9 worst mistakes you will make when buying a home. Let's face it, we all want to buy our house at some point in our lives, but it's important to not buy with your emotions. Always keep a clear-headed mind so that you can make the right financial decision so that you can enjoy that nice roof over your head. So how do you know if you're actually doing the right thing with the house that you're buying? And that's what we're going to cover today. Hello everyone, and welcome back to Novarise, your channel for financial education. So today we're going to talk about the 9 mistakes, actually the 9 worst that you could be making at the time of buying a house, or maybe you already make them. But if you're not, make sure you watch this video all the way towards the end so that you don't make those mistakes just like I did, or some of the other people who are watching this episode already did. So now, mistake number 1, not having your taxes in order. Remember, I mentioned in this channel over and over again that the banks look at your tax return before they even make a decision on whether they want to lend you money or not. Typically, the banks will lend you somewhere between 3 to 4 times of whatever you make or report in your taxes on a yearly basis. So if you're a cash earner, make sure that you're reporting all that income, because otherwise you cannot really blame the bank if they refuse to loan you the money or the amount that you're actually looking for. Why? Because they need to see proof. They need to see evidence. You can't just simply tell them, hey, this is how much I'm making in a year, and then just let the bank be okay with it. No, they need to see actual evidence that isn't written, and evidence that has been already verified by Uncle Sam through the IRS, and that's why they need to see your tax return. So always keep your taxes in order. Now, mistake number 2, not having good credit. Did you know that the better your credit, the better the mortgage rates you can get? Well, it's true that anybody can get a mortgage even with a 580 FICO score. But why would you want to chance it when you can work on your FICO score, get at least a 720 to get good rate? Yes, you heard that correctly. You need at least a 720 FICO score to get good rate in your mortgages. Now, mistake number 3, not understanding your credit. I know a lot of people look at their credit and they see, hey, I got a 620, 650, 720, 800, you name it, right? But do you truly know what makes up that score that you have, or what's preventing you from getting a higher score? You see, a lot of people go to the bank and they apply for a mortgage, and then the minute their credit report gets pulled, they are amazed at some of the things that they see in their score. Like, what? I have a debt from like 10 years ago that no, that's not right. But that's what happens when you're not monitoring your credit constantly, when you're not truly understanding what's preventing you from becoming better or what's impacting your credit. Sometimes you'll be surprised at how simple those mistakes are and how easy it is for you to fix it. So let's say, for example, you can go to a bank and say that you're interested in getting a mortgage, and you're filling up your application and you're saying that, hey, you have a total of $300 in debt. And the bank takes your application in, pulls your credit, and all of a sudden it shows that you have a $3,000 debt in your credit report. And when the bank is telling you about it, you're kind of like surprised, but you're like, no, that's wrong. I mean, I know my credit. I monitor it constantly. I understand my credit. And I will tell you that that $3,000 debt is not accurate. I owe only $300. And by you knowing that, you can immediately detect the mistake. The mistake could have been caused by a fat finger. Maybe whoever's working on the credit reporting agency had a bad day. Maybe they made a typo because they weren't paying attention. And instead of like typing 300 in your credit report, somebody typed in $3,000, right? That simple mistake can be fixed with a very simple phone call, and just within a matter of days, you can have that credit report adjusted and updated to the accurate information. And guess what's going to happen? Your credit score is going to go up, because it's not the same to owe $300 than owing $3,000, right? Your credit is going to see an improvement, but it wouldn't be possible unless you know what's going on with your credit. Now, mistake number 4, not understanding the financial terms when it comes to mortgages, right? So by that, I'm not saying that you need to be an expert in the field and that you need to know every single slang that is out there, but there are 2 terms right here that you truly need to become very familiarized with. The first one, it's loan to value. And loan to value typically appears in your offer letter as LTV, right? So What does LTV mean? So sometimes when you look at the offer letter from the banks, you will see an LTV of 80. So what does that mean? Well, it means that the bank is going to lend you 80% of the value of the house, and then you have to, provide the remaining 20%. That's why you see a down payment request of 20%. Sometimes you see a down payment request of 25. So LTV means whatever difference the bank is willing to put in for you so that you can get a hold of that property. An LTV of 75, that means you will have to put in a down payment of 25%, right? Now, the next term you need to become familiarized with is debt to income. So what does that mean, debt to income? Well, it just simply means the percentage of debt that you have in comparison to your income. How much do you generate, right? So the lower the debt to income ratio you have, the better the mortgage rates you're gonna get. And not only that, the LTV will also get better. Maybe the bank will give you access to a lower LTV. Maybe they're willing to finance with less down payment, and they'll be willing to give you more money so that you can buy more real estate. Now, mistake number 5, not having enough reserve funds. You might be wondering, what is it? Reserve funds. Well, think of it this way, right? We all have a piggy bank. We all think of, having savings for a rainy day. So having reserve funds, it works the same way for the bank. The bank wants to make sure that, in the event that something happens to you, maybe you lose your job, maybe, you're getting divorced, maybe an accident happened within the family, that you have enough rainy funds to cover the mortgage payments. And that's what they call reserve funds. Typically, the bank requests you to have somewhere between 6 months to 12 months worth of reserve funds. And here's a tip for you. The more reserve funds you have, the more chances you have to negotiate either a lower interest rate or just simply a better LTV or just simply better terms with the bank when it comes to your mortgage. Now, moving on to mistake number 6, and this one is actually one of my favorite. But before jumping into it, let me remind you that you need to hit the like button so you can help this episode rank and help others like you looking for information of this kind. And when you're still here, do not forget to hit the subscribe button so that you can continue to access videos like this every time we released it. Now, back to mistake number 6, and that is depositing large, unusual amounts of money in your bank account at the very last minute. So going back to mistake number 5, let's say that you did go to the bank and you're about to close, and all of a sudden the bank is saying, you know what, you don't have enough reserve funds and you need to do something about it, right? So what most people tend to do is that they go to their parents or they go to their friends or siblings or anyone close to them, and they ask to borrow the money. Just let me borrow $10,000. I'll keep it in my account. But then as soon as I close my mortgage, I will take that money and give it back to you, right? Sounds very easy and simple. Guess what? The bank doesn't like that. Depositing your salary, that's okay because they expect you to get paid from your job and they know that there's a recurrent income that is coming, every 15 or perhaps every end of the month. But when they see all of a sudden a large sum deposited right before that closing, they, red flags come up. They're wondering, okay, where in the world did you get that money? Remember, the banks are jealous. They want to be the only one in the equation. They don't want you doing business with anybody else. They want to be the only ones who get to collect on that debt. And by you having that large deposit of money, especially unusual, into your account at the very last minute, it's just something that makes them uneasy, right? So now, what's the solution to that? Well, the solution, it's planning. If you plan beforehand and if you anticipate beforehand that the bank, it's going to ask you for reserve funds, thanks to this video, now you know who to reach out and how long do you need to keep that amount in your bank account. So let's say if the bank is saying, well, we need at least 6 months worth of reserve funds in your account, and we're going to ask you, bank statements over the last 6 months to verify that. Now you know that whatever amount that you are either planning on saving or that you plan to borrow from someone else, now you're going to leave those in your account for the minimum amount of time that is required by the bank. Call it 6 months, call it 12 months. That's how you don't raise that red flag, and the bank could, be at ease that, hey, in the event that something happens to you, the bank will always get paid. Now, mistake number 7, buying more than what you can afford. And yes, I know we all love to have our dream home. We all want to have access to the house that we always dreamed of, that we know it's going to make us happy. But you know what? Some of us sometimes made the mistake of buying too much house, a house that we cannot afford. By that, I'm not saying you cannot get a hold of your dream house. But maybe you won't get it the first time around. Maybe you work towards getting it sometime down the road, right? And that way you can afford to be comfortable. Because let me tell you, living house poor, it's not fun. Having a nice dream home with no furniture, no bed in it, it's actually miserable. And in the event that you're wondering, okay, so how do I know how much houses can I truly afford? That's when planning comes in very handy. You go to the bank and you say, hey, here's my salary, here's my W-2, here are my taxes, and I would like to buy a house. I would like to know how much can I qualify for. And then the bank will collect all your documents. It's going to make you fill an application, and they're going to punch in a bunch of numbers and their formulas and stuff like that. And then towards the end, they're going to give you a pre-approval letter, and that pre-approval letter will have the amount that you actually can afford based on your behavior, based on how much money you make, based on the amount of debt that you have and your payment history. So that way you can prevent going after the $1 million house when you can only afford a $500,000 house. And believe me, it might not seem nice right now, but you're going to be grateful for it, because nothing beats being safe, feeling safe in your house, but being able to share that house with your loved ones. Having a $1 million house with no furnitures in it and being unable to showcase what you truly have worked very hard for is not fun. And let's assume you're a minimalist and you say, you know what, I don't really need that many furnitures, but hey, you still love spending time with your loved ones. Imagine that situation where you get to go out with them and you cannot even afford a meal just because you're house poor. Don't let that happen to you. Do the correct planning, work with the bank so you can get that pre-approval letter, so that way you know how much housing you can actually afford. Now, mistake number 8, not having an inspection. Okay, that's a horrible mistake for you to make, because let's face it, not everyone is honest. You can see a beautiful house on the outside and you can ask the realtor or the seller, hey, is there any problems with this house? Guess what they're gonna say? No. That's why you trust, but you verify. You always have to perform an inspection in your house, because that's how you know what you're actually buying. Are they truly saying that the house has no issues, and is that truly what you're buying? Or maybe the box is shiny on the outside, but the minute you move in, everything starts breaking. You get water leaks from the roof, you find surprises behind the wall, and you definitely don't want to deal with that situation like that. I've seen countless scenarios in where people are so desperate to buy a property that they don't even bother doing an inspection. And then after they take over, the nightmare starts happening. They have to spend a lot of money fixing a property that they shouldn't have bought in the first place. So don't be one of those. Always be ready with an inspection. And guess what? Besides that, an inspection can also help you negotiate. Let's say you do an inspection and you found some issues with the house that you want the seller to repair. Now you have the bargaining power. Now you can tell the seller, you either fix this or you will have to discount the price of the house, because I'm not paying for a house that has issues. Or maybe if they don't want to fix it, you can use that report. You can leverage that report to walk out of the whole deal altogether, right? That's in an extreme case. Now, moving on to mistake number 9, and that is including your closing costs as part of the mortgage. Now, if you have been following me for quite some time, you will remember that a couple of months ago, I released an episode where I talked about closing costs, right? But before you jump out of the video, here's the screen. You can take a look at it, but please don't jump out of the video. If you need a refresher or if you haven't seen it, feel free to tune into that video after the fact. But in the meantime, I need you to remain in this video right here, because this is important, right? So including your closing costs as part of the mortgage. Why is it not a good idea? Well, it's a bad idea because when you're including the closing costs as part of your mortgage, that means you're going to be paying interest on top of those closing costs. So let's say, for example, if your closing costs wind out to be $8,000, when you add a bunch of interest to it, you might end up paying 3 times that amount. And you don't want to do that. When does it make sense to add the closing costs into the mortgage? When you're buying a property that you want to use for an investment, when you're buying a rental or you're buying a house that you want to flip, because at the end of the day, the closing costs are not being paid by you. It's paid by your tenant or whoever's going to buy your property down the road, right? But if you're buying that house for yourself, for you to live in, for you to use it as a primary home, it doesn't make any sense for you to lump in the closing costs into the mortgage because you will be overpaying, and especially you are overpaying with your own money. You always want to pay with other people's money. So if you don't have the cash to pay for the closing costs, always leverage a 0% credit card and use tools like plastic so you can actually cover the cost of the closing costs and you don't have to worry about interest down the line. Now that you're here, I want to know what happened. Did you learn something new? Did you make any of these mistakes? Tell me about it. And if you haven't bought a house yet, tell me, what do you know now that you didn't know before you watched the video? These are some of the mistakes that now you can prevent because you actually took the time to invest in yourself and watch this video. And while you're watching this video, make sure you tune in into this video as well, because it's going to help you complement everything you just learned today. And until then, I'll see you guys soon. Take care. Bye-bye.